Okay, hey everybody. I see a couple of you guys online there, so that's great. We're going to get started here in just a minute. We're going to get everything ready to go. I'm going to share my screen and kind of see what we can do here too. Oh, please let this work. I'm hoping this is. Okay, real quick, everybody on Zoom, can you see my screen? Just a quick thumbs up or someone to say yep.
Yep,
Yeah.
I can see it.
Okay, perfect. Thank you.
That's a hard job out there, huh?
Yeah.
Getting better about pouring though.
Yeah, she's got to work on it.
Are these all the same sheet cloth?
No, there should be three. Yep, I just did them for just in case for two people that were sitting there. Yeah, do what you got to do. I just want to make sure we had enough. Okay. Oh, that's all right. Thanks. I'll sip on this as I'm talking.
I'm glad I poured you so much. Just stick a tiny bit in there.
Yeah, it's okay. Okay. Oh, yes. Sorry about that. I just plopping all my stuff down. And
You didn't leave any room for me?
I didn't. I'm sorry. Okay. All right. Well, everybody, good morning. Thanks for, well, happy St. Patrick's Day. Right. Thanks for coming in and kind of, joining us today to, just discuss interest rates. I mean, everybody knows kind of like, the market that we're in right now. But I think what it really helps and really gives a better understanding of what rates are doing is just understanding what goes into them, what changes, interest rates, what causes them to go up or down, all those different factors I think is just pretty vital. And the more education you learn and have the understanding of, kind of like on our side of the business, it's just going to help you grow even more. Okay. So what I wanted to kind of start with first is just to kind of go over and let you guys just watch a short video through our MBS Highway, our marketing, guru specialist guy. This is just such a great informative way to kind of break things down and just to kind of give you an understanding of what the market's like and, good things. So let's just watch this and then we'll get into the documents that I provided you.
And then real quick before you play that, so MBS Highway is a platform that we Cross Country personally pays for. That it's one of the Barry Habib. He's one of the #1 economic forecasters in
Amazing
in the country. So like this information is super educational.
Yeah. So, and everybody on Zoom so they can see my screen. So we'll go ahead and start this video. There we go. Yeah. Yeah.
That's not playing on my screen. I can
Good
see it
news.
on yours. Hey, Cliff,
Yes.
we're not getting the video. We can see it playing behind you, but we're not getting it on our feeds.
Okay.
Maybe just go over what the overview of the video is about.
Okay. All right. And I'll send this to you guys too, if you want to ever take a look at it, because it's really good to kind of look at real time too. So, okay. No problem. Well, I mean, basically what we kind of wanted to discuss is, oh yeah, thanks, Aries. Is just kind of going over, what the market's doing right now. And as you heard, as far as like with the big banks and with the consolidations and things, what he was already kind of discussing, like, okay, so what is this pushing? How is this changing, a buyer's interest rate now to increase their buying power, lower it, you know what I mean? And so it's basically just having that understanding of what's going on in the marketplace. There's so many different factors that play into this game of interest rates than we actually know. So what I'm going to do now is go ahead and grab your papers real quick, guys. Here, I'll give you. No, it's okay. Here's what I was going to go over too, so you can, kind of follow along and go along with that too. Okay, guys, hold on. I'm going to clear off this video here and then pull up my PDF and then let me know if you guys can see those as I do that.
Are you able to share the link to that video?
What's that? I'm sorry.
Are you able to share the link to that video?
Yeah, I'm going to see if it's possible. It may be tough because you may have to have your own login and everything with it, but I'll see about how we can get that figured out.
Yeah.
I know, man. You got to hook me up here. Let's see. Let's do. Well, we'll go over these first so everybody can see these. Let me see if once I reshare, they can see these or not. There we go. Okay, all right. So everybody on Zoom, can you see these forms that I have on the screen now? At least can you see these?
Yes.
Okay, perfect. Okay.
Yes.
All right, guys. Well, this is going to be kind of a good informative and kind of like an interaction because I want you guys to engage and kind of, it's a lot better to kind of do this together. It'll really kind of help, open up the understanding in your minds too of how things go. And so I'm going to start just by reading, like the first paragraph, and then we can kind of discuss and go on. So, but the importance of understanding why interest rates change. Okay, it is important for investors to understand the prospects of interest rates moves as they value their investments. However, understanding why interest rates change require appreciation that there are a number of complex factors contributing to these movements and changes in interest rates. They include strength of the economy, which we'll discuss and go over that, which supply and demand, which we kind of already know. But a couple other policies that are involved are the fiscal policy, the monetary policy, and the level of expectation for inflation. All these different kinds of factors. And there's a couple that aren't mentioned here, like the jobs reports or kind of like what's going on in other countries as well. But this gives us a good understanding on why interest rates change, okay? So as we move on to the next one here, it says why interest rates change. Interest rates change over time, reflecting both the demand from buyers and the supply of funds available to be loaned providers of capital. The best way to think of interest rates is the price of money. This is a good example. I like this one. If a borrower wants to spend more than his or her actual cash on hand, they will need to find someone to lend them the additional funds. The lender will turn in and consider the benefits of keeping his money or spending of his own money and putting it into an investment, which is basically underwriting a borrower, which means looking at their total credit profile from, credit score to, reserves, assets, all the different factors that could potentially give a borrower's credit worthiness on getting approved for a loan, okay? Obviously, the higher the credit score, the better interest rate opportunities, depending upon which program, okay? And then both the lender and the borrower look at an interest rate payment on the loan amount and the percentage of terms. Just another example, like a $5 interest payment over a $100 loan that is outstanding for 1 year is called a 5% interest rate, say 5 divided by 100. The interest rate charged to the borrower reflects the level of risk that the particular borrower might default on the loan. The rise and fall of interest rates is very difficult to predict why interest rates change. is reflected through economic growth, monetary policy, and fiscal policy. Okay, to kind of touch base a little bit about what we discussed there. Everything is in regards to lending and interest rates, and credit profile is risk. Okay, when a buyer is approached, to see about what kind of financing that he or she may be able to get, they look at everything. So, and when a lender looks at from an underwriting standpoint is, okay, the risk factor. What is this borrower's ability to repay, the debt? Like, what goes into, should we give this, this particular borrower, money to borrow? Okay, all those kinds of factors play into that, this portion of what we're discussing as far as interest rates and what they could change. Okay. Now let's move on to, the factors to consider. Economic growth. This is a really important one. We'll spend a minute on this one too. The most important factor in determining why interest rates change, and this is just from an economic growth standpoint, guys, so don't let this confuse you with anything else. It's just from an economy standpoint, okay, is the change in supply of funds available for the lenders and the demand, from borrowers. Let's use, the mortgage market, for example. In a period when many people are borrowing money to buy houses, banks need to have funds available to lend. These funds can come from their own depositors. Say the bank, pays 2% interest on a 5-year GIC. GIC is a guaranteed internal certificate. The charge for 4% over a 5-year mortgage, by a borrower for their depositors lending their money. Their borrowers make a 2% net margin on their profit availability from what the market is saying. Okay, so but if the demand for mortgage becomes higher, then available funds that the bank either will have to raise their GIC rates to attract more retail funds or borrow money to be issuing bonds to institution is the wholesale market, basically what their loan would be worth to an investor on the open market, which is a package deal, which means the underwriter or the lending institution has verified all of the qualifications for the borrower, pay stubs, W-2s, asset statements, all those things that compile into their loan application. What is it worth on the open market based at that interest rate? How attractive is that to an investor to purchase? Is this going to be a long-term type of a loan? Is this something that may be an interest rate that they may not make all of their return, so to speak, in over a 30-year time? Could this possibly be refinanced? All those factors come into play when you're talking about the economic portion of how it's broken down with interest rates. Okay. And then, but if the demand for the borrowing becomes higher and available funds, the banks will either have to raise their GIC rates to attract more retail funds or borrowers money by issuing bonds to institutions to the wholesale market. Institutional investors have more investment opportunities, so this source of funds is more expensive, and the banks might have to pay, higher interest rates. Mortgage rates will then reflect the higher cost that's reflected back on the bank, and funding it could potentially make it a little bit harder to obtain. So if the banks have lots of money to lend and the housing market slows, any borrower financing a house will get special rate discounts, and lenders will be very competitive again, keeping rates low. Basically what kind of happened back in 2000 and sort of 2001, when the inventory was pretty good. You had lots of borrowers. With COVID, with inflation not being an issue yet, interest rates were low, and you saw the demand and a lot of fight over properties, things like that. But people were also getting the 2s and 3%, getting more bang for their buck. Okay. So, but any questions, so far on just these first couple topics that we kind of went over? I know it's a lot, but I really want you guys to try to have a good understanding of what causes interest rates to change and like really how it makes up the importance of them. Anybody on Zoom, feel free to stop me or let me know if you guys have any questions, or if you want me to go over anything again, we can do that. All good to move on? Okay. All right, so fiscal policy. This is some cool stuff too, guys. Okay, so fiscal policy, the same logic applies to the credit markets as a whole. So in a booming economy, many firms need to borrow funds, to expand their plants, financial inventory, and even acquire other firms. Consumers might be buying cars and houses. That need keeps the demand for capital at a high level, interest rates higher than otherwise might be. Okay, the government will allow borrowers also, if they spend more money than they raise in taxes to finance their programs through deficit financing. The way governments spend their money, finance and debt is called a fiscal policy. So that's really like the general term of what a fiscal policy is. A high level of government expenditure and borrowing makes it hard for companies and individuals to borrow, lending, and what's known as the crowding out effect. Okay, and we'll kind of get into what the Fed, has to do with the majority of everything as well. And so another major factor affecting why interest rates change is the monetary policy. Okay, so central banks alter the money. Central banks, AKA, the Fed as well, alter the money supply to try to manage the economy and control inflation. If a government loosens monetary policy, this means that it has created more money. A central bank like the Federal Reserve Bank the Federal Reserve or the Bank of Canada will actually create more money by depositing it into accounts into commercial banks. Okay, this makes interest rates lower because more money is available to lenders and borrowers alike. So if a supply of money is lowered by drawing, if the supply of money is lowered by withdrawing money in banks, monetary policy is tightened, which causes interest rates to rise. So that's another way that can cause interest rates to rise. Us not seeing this on a day-to-day basis, this is the kind of the things where these market updates that we have by MBS Highway, they analyze all of this data that's going on, and they'll be able to let us know all the different factors that's going into these changes and updating us, and it's real time. So it's not something that takes like a week or two to potentially build up and then make change. All of these updates that we've been kind of going over and everything that we're used to seeing is what changes things on a daily, and it could be on a daily basis.
And just to interject really quick right there, that's why you will see some fluctuations when customers are shopping rates. Because with us, when we offer a customer a rate, it's in real time. When banks offer customers a rate, they automatically commit to a certain amount of loans at that rate. So if the rate today is 6.5%, the banks, say Huntington says, okay, I'm going to commit to 10,000 loans at 6.5%. And then the very next hour, the rates go up to 6.625%. Well, now we're in real time and Huntington's at a 6.5% rate. So it's nothing that we can control, but that's why we offer a price match guarantee. It's not that we're not giving the customer the best rate that we can up front, because I've heard that so many times. It's simply because the market has moved and now that rate has changed. And sometimes it's an advantage for us. Sometimes the rate goes down to 6.375 and Huntington's at a 6.5, and now we're better. So it looks like, we have a better rate. So that's just to help understand a little bit why the rates change and why you do see some fluctuations throughout the bank versus lenders that give rates in real time. And it is super strong right now because the market is fluctuating so much.
For sure, and yeah, that's a great point that you mentioned, because on the flip side of things, if it's something that cross country, if our pricing is, say, like she mentioned, say 6.5, as opposed to at that real time pricing in Huntington or Chase or PNC or whoever is at a 6.375, they're locked into that for a long duration. Okay, it could be for the remainder of the week, the month, or what have you. Real time pricing.
Yeah, till those 10,000, to whatever loans that they committed for are gone.
Are gone and sold off.
Yeah.
Yep, that's kind of how it works. So with us, it's real time. So which could give us a competitive advantage as well.
I know what I've said over the years when buyers tell me they're rate shopping or whatever. I've got my canned speech or two. Give me what you just said. Give me that, what you would say like in a sentence or two. If my buyer's like, yeah, okay, but I always bank with Huntington, or I always bank with PNC, and I want to just, what's your canned speech for something like that? What you just said.
And just in regards to rate or overall, like.
It's a loaded question.
Let's just say rate.
Okay, so with rate, I would tell them, the bigger banks sometimes they don't have any fluctuation when it comes to their rates. They offer you one set rate at one set price. You should be able to spend your money the way you want to spend it. So you should be talking to a lender that has the ability to fluctuate your rate and fluctuate your closing costs. And if you're not giving that option, you're not utilizing the best way to spend your money.
Right. Yep, absolutely. All right, so real quick, guys, too, on this third page here, pull this one up. I just want to kind of discuss, inflation, because I know it's a topic that's been very sensitive, over the last, year or so, I would say, kind of leading up to now. And it's just a good, to have a good understanding of what causes that, and just, and feel free to ask questions if you guys want to get into that even further. But I just wanted to give you like a general idea of what inflation was and how it affects everything. It's not just mortgage rates. It affects everything at the cost of living, a cost of goods, so to speak. So inflation is when general price of goods and services rise in an economy, okay, which may be caused by the nation's, currency losing value, or by the economy being, overheated, so to speak, and growing so fast for the demand for goods is outpacing the supply and driving up prices. Now, this is where I kind of want you guys to kind of come in and kind of, tell me what you guys are seeing, with you, because inventory, I mean, I know a lot of people are talking about there's not enough houses. Okay, so the inventory, the things that could factor into what interest rates could do is the homes out there that are available, do they need a lot of work? Or is it just homes that are just not in good areas? Or fill me in on what you guys are seeing, because I kind of want to get an idea just so we have the totality of what we're trying to figure out here together. Yes.
I remember when Tony and I were actually looking for a home for ourselves. Find a house to pay like $250,000, which isn't a cheap house. And it was typically built in the 80s, and it was just completely dated. Not that it needed a lot of structural, work, but cosmetically it was just undesirable. It was like, I knew I would have wanted to like update every finish in the house, floors, everything. And then you're looking into dumping in, I don't know, 100,000 into just making it modern. And
Okay.
it just feels like you just don't get what you used to even 10 years ago, and it's kind of what's the word I want? Stagnating.
Yeah. Yeah.
There's not a whole lot that you can get, and it's, to me, that's not a cheap house.
Yeah.
So
No.
Yeah.
Okay. Well, yeah, Cerise.
A lot of the houses where I'm at, they're listing it where I would feel like the house would be if it were updated.
Mm-hmm.
So it's pricing a lot of people. It's 46.
Wow. Mm-hmm.
165,000. Can't get
Mm-hmm.
a lot of this house to be burned for lot of clearing, road. Like 2 days ago,
Mm-hmm.
like it was more maybe, yeah, even not even being updated with what it was inside of the name, like it hadn't been touched for about 20, 30 years.
Right.
And paint's chipped all over the stairs and everything. So places that are available work that unless someone actually has funds available to do the work and the connections to find someone cheap enough to do it.
Mm-hmm.
Then they're kind of
Sure.
I mean,
Mhm.
that-
Yeah.
Like just they're overpriced, they need way too much work.
Mm-hmm.
Like the one I was in a couple of years ago, they left the water on. And the listing agent had to have known, I don't understand how you couldn't.
Yeah.
When we went back and the picture from the kitchen and living room was from last year,
Mm-hmm.
before the damage. And none of this, there was mold, none of this was disclosed anywhere.
Wow. Was this a single family or was this a 2-unit? What kind of?
This one was a single family.
Okay.
We saw 3 that day and they were all really rough shape.
Wow.
Overpriced, and then like you were saying, for the amount of money that it would take to bring back and I told the guys, like, you know, spend your money elsewhere.
Yeah,
Not the one.
yeah,
And he also bet, I'm sorry.
No, go for it.
yeah.
You, like, you have loans? like
Yeah.
RBCs,
That's what I was just gonna say.
Yeah, that's what I kind of wanted to get into too, is, and you're going to start to see that be more of a common thing. But like, you know, kind of Tony was referring to, you know, and Zarice even for that matter too, as far as these investment properties that are out there. Eventually, guys, you're going to see that asking price is just going to have to come down because it's going to have to warrant whatever the purchase price is, okay, plus what the cost of renovations is, which is going to be the subject to completion value. Like, what's this house going to be worth after I fork 50 grand of renovations into this home? So, I mean, because in theory, say you purchase the property for $80,000 and you put 50 grand into it, you know, the house should appraise subject to at least 130,000, right? That's what it should be. So, and not really any less. And so now you got to see, okay, so what's that market like in that area? So what comparable comps are going to be to support this value if I do A, B, and C renovations to help fix up the property? Because a lot of the renovations too, which Jessica and I love to kind of go over with clients is helping them understand what renovations actually are going to bring value. Because some of the renovations that are out there are just, you know, maybe personal kind of preferences and just to make it pretty and look nice. You know, redoing a kitchen is not going to bring as much value as just, you know, getting some appliances that you like, or, you know, putting some flooring in or something like that, like adding an addition, bathroom remodeling, roofs, you know, those kinds of things are going to add value to the property as opposed to some of the cosmetic things. So all of that, you guys, is going to play into what the properties, you know, could potentially be worth after this is going to be done and which way the market is going to shift. And as we kind of grow more into not just renovation loans, but I'm getting, and this is for another time too, but just to kind of touch bases, construction is, I'm going to be getting back into more of my construction loan panels because this is going to help with inflation too, guys. The builders need to build more houses. But again, what goes into that? The cost of goods, the supplies, you know, the time, the labor, all these things. I mean, the standard construction and perm program, you know, process used to take anywhere between 6 to 9 months, guys. That was like the norm. Okay, now you're 12 months out, if that, you know, and so it's a whole different factor of how many houses are being built that are going to help cause or help cure the inflation aspect of it when it comes to that portion of it, is having more homes, being that little piece of coming back into helping change interest rates, you know, and what could factor in the risk of them going up or down.
Yeah, and that's one thing why it's a little risky for our customers to do a renovation loan, is because they could pay for multiple appraisals. And if the renovations that they're doing, it doesn't increase the value, they can't close on the loan unless they bring the additional like difference of the price. And that's why customers that are limited with funds up front probably shouldn't be getting into a renovation loan, because if they don't have a backup plan to cover that difference, they literally can't close. And now they've just spent all their money that they had for appraisals and inspections and nothing's left and they can't close. So it's finding the right buyer too.
And their down payment, you guys, is based upon not just the purchase price, it's based on the total cost of renovation. So if it's 180,000 to get the work done between, or 130,000, we'll say, between the 80,000 of the purchase plus the 50 grand in renovations, they're 3.5% if it's FHA, or 3 to 5% down if it's conventional, is based on the totality of that combined amount plus their closing costs. So, you know, it's recent, I had a client that we had closed, you know, a renovation loan, and, you know, she had her funds and everything in place. You know, she wanted to do some more renovations, but we had to also kind of dial it in to make sure that we had enough to make sure we got the deal done. And so, I mean, it just depends on, every situation is going to be different.
Okay.
Oh,
Even like
mm-hmm,
are quoting $200.
mm-hmm.
So the bill is for that houses.
Yeah. The cost, lumber.
So that's, I mean, I don't even know if it's lumber at this point. Lumber,
Yeah.
like it's higher than, you know, years ago, but it's not like what it was. You know, 3 years ago.
Yeah.
Yeah.
It's the fact that builders and contractors themselves, because as soon as we get fixing talking about
Mm-hmm,
that first quote that we had, 100,000
mm-hmm.
or 200,000. $200,000 for renovation.
Mm-hmm.
There's no way.
Right.
So like, my question is, how hard is it for a contractor to get signed up with you guys? And, because I think that if we have people that we know that they do this for a living and they're getting their business established and everything, those are the people that might be our clients, right?
Yeah.
Because the other ones, because they're established, you have to name them.
Yeah.
They're charging top dollar for every single thing that you do, and it makes it possible for clients to use.
Right.
Because they might only have 56,000
To work with.
and you have a contractor that's trying to charge them 150,000.
Right.
Really shouldn't only.
Exactly. I mean, that's why we try to go over and educate as much as we possibly can with the buyer, give them a list of renovations that are going to help increase the value that, you know, that can make sense for them budget wise. I mean, that's really all we can do, because everything else, you know, if it's the luxury thing or just the other added add-ons, you know, those kinds of things, you know, because yeah, it looks great when you see it, like when they do your model and they're like, hey, this is what your house is going to look like after we're done. Here's the before and after shot. It's all about, you know, getting the house to what you want, obviously, but within their means, and appraising for that as well, you know, because they're going to have, the home's going to have to appraise, you know, for that as well. And well, that's another reason why we're kind of like the process of getting an approved person from a renovation loan is a little bit more tedious than new construction for nonsense like that, you know. Some of these cats that are trying to. Yeah. Oh, good. Okay. Yeah. Yeah.
Like, what do they actually need to get signed off?
Right. Yeah.
We send them so if it's a builder, we send them a builder packet,
Yeah.
and then it takes about 4 to 5 days to get approved. So if you know the builder, get them on board. So then they only have to fill it out once. And then I think there's, I'm not sure how often they have to up their renewal, but
Yeah.
I might know that.
Yeah. I mean, normally they review everything every 6 months to make sure that they have the right, you know, insurances and everything in place. And then if they meet the criteria, I mean, because once they're approved, it's so much easier, because then they just send them out an update and it'll show that, hey, okay, yes, here's my updated HIC, you know, or my whatever type of, you know.
Yeah, and then they know they're a good builder, because like Cross Country is not going to lend to a builder that doesn't meet the financial qualifications. So if they have liens on them or, you know, a bunch of complaints, there's a whole builder packet. We can send it to you.
Yeah.
Yeah.
I'll get it over to you. We got it.
I have
You
it.
can see.
I have it. I'll send it to you right now.
Yeah. Yeah. As ironic as it is, it's a lot easier to qualify them for new construction as opposed to renovation, just because it's just the nature of the business. There's been quote unquote more shystiness, so to speak, on the renovation side as opposed to the new construction, because you have to have your certain, you know, criteria in place. You have to show work that you've done. You have to have right, you know, builder's risk insurance. All those factors go into play, and the builders already know it and they have it ready. So. Yes.
I have a house for sale, but it was damaged from fire.
Okay.
Is it, do you guys go along to the fire? I mean, like, if the one fire to the house, only damaged to the fire.
Okay.
I just marked cash only. I wasn't sure that somebody could get a loan and.
Absolutely. Yeah.
So,
Yeah. If it's to renovate or to fix up a property, 100%. I mean, we've had people that had renovation loans, but that's been flooded or storm damage. Or, you know, I had a client, this is about a year and a half ago, did a renovation loan, tree hit his house. You know, those kinds of things just happen.
no, I mean, not the seller, the buyer.
The buyer, yeah,
Just the buyer, the renovation.
yeah. If the seller's willing to yeah, absolutely.
Okay.
Yeah.
I wasn't sure, that's why, I mean, I have a lot of people see the house, but since it's cash, you know, like.
Yeah.
Like you said, you have all the photos.
Oh, for sure, for sure,
And
yeah.
you don't want, like the builders or contractor, you know, construction thing, you know, like they don't all offer, so you don't want to just
Yeah. No, that's a good question. No, absolutely. You want to switch? Yeah.
Okay.
Jessica's going to talk about rates and pricing and how we do it like in our system.
Yeah, so I mean, all of like this is good to understand and the terms and the knowledge to have behind it, but like when you're selling it to a customer and we want to see live examples. So what I did was I pulled up a couple of different loan estimates, and can you guys see that on Zoom?
Can you see the loan estimates,
Can you
guys?
guys see the loan estimates on Zoom?
Yeah.
Okay, great. Okay, so I just pulled a couple of different examples, wanted to kind of show you. So when we're looking at interest rates, we're looking at three main things to determine the customer's interest rate. We're looking at what is their credit score, how much money are they putting down, and what is their debt to income ratio. So like for a conventional loan, you can go up to a 49.99% debt to income ratio. So if the customer is at a 30% or a 49.99, they're going to be offered a better rate at a 30% debt to income ratio because they have a lower risk. The investor knows you're not maxing yourself out. So we're going to give you a better rate because we want your loan. You're a 30% debt to income ratio, you're an 800 credit score, you are going to pay this versus somebody that's a 600 credit score at a 49.99 and they have a bunch of collections on their credit report. So in this industry, we get asked the question all the time. I mean, I probably get texts every couple of days, especially right now. What are the interest rates? I'm doing a podcast and I want to talk about rates, or I'm doing a Facebook announcement. I want to talk about rates. What are the rates today? And I would love to be able to give you one rate, but like we had said earlier, we're not a bank, so we don't have one set rate. I mean, the customer literally has probably 15 different choices when it comes to their rate. They can pick what they want and what they want to pay for it. So when we have a formal loan application and the customer goes under contract, that's when you can lock the customer's interest rate in. Now, there's a lot of companies out there that offer the lock and shop, and they tell you if the rates drop down, you're going to be able to get the lower rate. But what they don't tell you is that there are regulations that the rate has to drop by a certain percentage before they can give you the lower rate. They just advertise, oh, we're going to give you the lower rate if it drops. So each company is a little bit different, but it's typically anywhere from 0.5% to a full percent of the rate dropping before the customer can utilize the lower rate. So cross country, I mean, we can do it, but most of my customers really don't choose to do that because the rates typically don't fluctuate 0.5% to a 1% in a 30-day period or a 60-day period. You know, it's normally 1/4 to 1/8 to a 0.5%. So once the customer goes under contract, then we can lock their interest rate in. We do lock their interest rate in for the duration of the contract period. So if you have a 30-day closing, typically we're going to lock them in for 30 days because the longer you lock an interest rate, the more it costs the buyer. If the customer is like in between, then we'll always go higher to the higher rate lock. So I've had questions before like, well, we have to pay for a rate lock extension. Well, why didn't you lock them longer in the first place? Well, because we locked them off of the date that you put on the contract. So like, those are things to understand. If we're not closing on time for whatever reason, if it's cross country's fault, we will for sure pay it. It typically doesn't happen that it's cross country's fault, but if it does, I mean, we make mistakes too. Like we will definitely adjust the customer's rate and pay for the rate lock extension. If not, it's on the buyer or the seller to cover. No, we can.
I remember back a year or so ago, it was 45 days before you even think about it.
Yeah, no, so we can go up to 90-day locks.
Yeah, good question, Sam.
That's a great question, but the 90 days is going to be the most expensive, and it's not offered by all investors because there's so much that can happen in 90 days. The customer's credit could change, the customers could lose their job, their incomes could change, whatever it may be. And that's why pre-approvals are only issued for 90 days as well, because there's so much financial things that can change. So I just wanted to kind of dig into both of these examples. Like you can look at this customer here. Purchase price is $525,000. This guy is a guy that's relocating from New York, and he is living in a hotel right now, and this is why I wanted to show you one of these examples. He's living in a hotel right now, and he needs to close as quickly as possible. And he wanted to pay as little closing costs as possible. So he chose not to have any points and took a higher rate. He has a 6.875 rate. And he didn't want any points, and he actually wanted a rebate because he's going to be in the house. So this customer got a rebate towards their closing costs to make their closing costs lower. So when you look at a loan estimate, this is where the points would be. The only thing that a lender can control is in box A. This is it.
That's it.
That is it. Everything else on this loan estimate, all of these other columns, B, C, D, all of them is all third-party fees. So when we were saying earlier, we let the customer choose how they want to spend their money. I could have easily charged this customer up to 2 or 3 points, which at this much of a loan amount, $420,000, let's just say I charged him 2 points, he's going to be close to 8 or 9 grand. And he knows he's not going to be in the property. He knows he's selling. He's living in a hotel. He's literally just buying a house that he can right now. And then he's going to come and find the area and, look a little bit better on where he actually wants to live. Now, I wish we all could just, buy $500,000 houses when we want, but that's a whole different story. But so just so you could see, this customer didn't want to pay any points, wanted the cheapest or the higher rate, and got the rebate for their closing costs. Yes, I can't. Yeah, because it's another client. Yeah, so. But I can go over examples with you. No. Oh yeah, for his next house.
Yeah, we'll try. You know what we can try to do? We'll try to reach out to maybe like our internal corporate team and be like, hey, can we have like a dummy
Yeah.
good faith estimate that we can print out and kind of go over line by line and itemize it that way?
Yeah.
That we can hand out. Yeah.
Yeah, so loan costs are the only thing that we control, and our underwriting fee is $895. Our processing fee is $795. We're not the lowest and we're not the highest. We're literally right in the middle of the road. And I always say this, like, me answering my phones on the nights and the weekends, as opposed to a bank that charges $12.95, like having our quick close times, local appraisers, like all the service that we offer, like that's why ours is slightly higher than a bank, but it's it's quality that you pay for.
Exactly.
Yes.
I think it's processing fee.
Mhm.
So when you mentioned, that the 90-day lock is the most expensive. is that
Yes.
where the expense comes in?
It would be listed under here. No, it would be as a separate, it would be in the discount points.
Okay.
Yes, so the lock is in the discount points. So, but it's not here because the customer took a rebate, so they essentially didn't have to pay for the lock. But that's why their rate's much higher. That's why they're at a 6.875 versus, I think, I don't remember, because I think the market that day was a 6 1/4. So he literally took a 0.5% higher to get the lower rate. So that's just one kind of example that I wanted to show you. And then here's another one. This was a younger client putting a little bit less down, not as much as the other client was. She got a 5.875 rate. She is going to be in the house for a very long time. And she paid an extra 1 point. So she paid 1.125, which was $1,482 to drop the rate to a 5.875. So just to kind of, I'm going to go here to oops, I always do this on your thing.
So what's the cost for like that buy down?
That's what I'm going to show you. So, it was only, did I just mess this up? Can you guys still see the screen, the loan estimates on the screen on Zoom?
Yeah.
Okay, great. So I'm just going to show you the difference. So if we go over to the difference in, like what it saved the buyer. This is the calculator I like to use. I don't know why, but I always use it.
I'm always using my phone.
You'll see like the difference of what it like saved her over a 30-year period. Now, this made sense for her because she's going to be in the property. Well, I mean, she says she's going to be in the property 30 years. Who knows if she is, but her intentions are to stay there longer than our other guy who doesn't want to be in the house more than a year. So loan amount was $133,000. And I'm just gonna take out everything else but the rate. She could have been at a 6.875 if she didn't want to pay that extra money. She would have paid back $314,000 over the life of the loan. She chose to pay the extra money to the 5.875. And now she's paying back $283,000 by buying a point. Now, the other reason why I wanted to show you guys these two examples was because this customer's credit was an 800 and this customer's credit was a 670. So now you can see why her buy down was so cheap, why she only had the, the 1.125% points. She also was under the area median income, which she also got a discount for because she, I think, made like $33,000 a year. So you get a discount when you're under the area median income as well. So I thought these were two really good examples, just kind of so you can see the difference of a customer's profile really makes all the difference on what rate they're being offered and what options that they have. But if your client is working with a lender that is not giving them these options, this is not fair to them. Like you just saw the difference. The customer could have, if they just went to their bank and their bank offered them a 6.875 rate and didn't give them the option to buy it down, which she did come from a second opinion. This was a second opinion for me. And as soon as I ran this amortization and I showed her how much money I could save her, it was a done deal.
Yeah.
So, I mean, we preach all the time about second opinions, but there's a reason for it. Like, are we the best all the time? No. I mean, 99% of the time, right?
Yeah, pretty close.
But we really try. And if we can't save the customer money, like we're going to tell them to go back to their bank, or we're going to try to match it to get their business, because we're competitive and we make money. We don't make money unless we close loans too. So, yes.
I guess my question about the buy down was like a quarter of a point costs how much? Like you're buying it down, so that would be, they want a whole point.
Yeah.
So they're paying whatever it is times 4 for the cost to buy that down.
Correct. It's typically 1 point is typically a quarter of a point. This customer's profile though was so strong as opposed to the other one that her buy down was way cheaper than his would have been.
So the cost does vary.
It
depending on the
does.
other factors.
Absolutely. Yeah, that's the whole point of
It's not a set.
it's
like,
not.
so-
There's
It was.
like a rule of thumb if you're comparing two apples to apples, but you're never it's very rare that you're comparing the same client to.
So for this gal who was the $133,000 one.
Yeah.
So what was the quarter of a point?
So she
What did
paid
purchase for that buy down?
1.125% to get almost a point buy down, but she also had discounts because of her credit score
Okay.
and because she was under the income limit.
Mhm.
So so it wouldn't have technically have been a full point, but she got those benefits. And when did this close? Not that long ago. This was in February and she got under a 6% rate.
Mhm.
So it's just good to ask the questions and find out actually both of these customers were with other banks. The other customer was in Florida, was from Florida, an online lender from Florida. I don't know how they got connected, but yeah,
Yeah.
I know.
There you go. I'm glad you said it, not us.
Yes,
Under the, did you call it under the area?
yeah, under the area,
And that's under an income limit.
yes,
Is that
the
something banks do as well, or is that across?
no, that everywhere should offer some type of
Yeah.
service
Not
for that.
everybody does, but.
Not
they should.
everybody does, but like a special program.
Yeah.
No, because any banks have overlays. So banks, I mean, lenders they have to offer fair regulations, but as long as they offer the same regulation to every client.
Mhm.
So it's kind of like when I say an overlay, so let's just say Huntington says, I'm not gonna lend to any customer under a 650 credit score. They have the right to do that as a bank because they're lending the money, but as long as they offer that, they can't say to one client, oh, you're a 640, but I'm gonna lend to you.
Right.
You know, they have to make it across the board. Where with us, that's one of the reasons why we get so many loans done is we underwrite directly to what Fannie, Freddie, VA, FHA guidelines state. Like if their minimum guidelines are our minimum guidelines, so we don't add any extra overlays to them. And that's sometimes too why when we do get a lot of second opinions, they come to us for like sometimes we can get them approved for higher amounts because their bank does have an overlay for the debt to income ratio, and it might be 45% where we can go to 49.99. Like I know Third Federal is they're really bad. They're 42%.
Yeah.
They won't, I mean, I think I've used this
A hard
example
stop.
before. Like one of my girlfriends came to me for a refinance. She was going through a divorce and she got denied at Third Federal because she was at a 43% debt to income ratio and her credit was 800 and the appraisal under appraised by $40,000. And because they didn't use a local appraiser that didn't know the area. And she came to me for a second opinion and it was like, I think we had it closed in 2 weeks. It was the easiest loan I've ever done.
It's unbelievable.
So
Isn't it?
I mean, and that's an extreme example, but it still happens. So it's just making sure, you know, and if you hear a customer say like, oh, I don't qualify, I talked with my bank, definitely send them over because those are the ones that we probably have a better chance at too.
We'll find out. We'll figure it out.
Yeah. But that's kind of an overview on, you know, especially right now, just keep in mind, what I really want everybody to keep in mind is that there are so many mortgage lenders offering different rates right now because the market is changing rapidly. There are some lenders, and we've already seen it this year, there are some lenders that are throwing out the lowest possible rate because they're struggling and they're about to close. And they need every business that they can possibly get. And what was it? I think it might have been Flagstar.
Things like that.
Yeah, they're offering credits, they're offering
Not
the
good.
lowest rate because they need business in or they're gonna close.
Mhm.
And that's great for the customer if nothing happens, but their operations is probably backed up because they probably have people, like if they're doing that to get business, they're probably laid people off. They're probably understaffed. They're probably not working locally with their appraisers. So if you see something like that, it's automatically a red flag.
Yep.
You know, and then also too, like be vocal about it. Like if you are working with your loan officer and you have a client coming to you saying, I'm going to leave Jess or Cliff or whoever their loan officer is, and you're comfortable with the loan officer and they're saying, no, I'm going to Quicken Loans because Quicken Loans is giving me $5,000 off my closing costs. Like talk to your loan officer about it because the clients are being hammered by every mortgage company right now to try to get their business. As soon as they do a credit pull, and I did this the last class, that as soon as the customer applies, the credit bureaus sell their information to the mortgage companies that are buying the leads.
Not their social or anything like that, but
Yeah.
that there was a mortgage
Right.
inquiry.
And it's not us. Sometimes they think it's us that it's selling, unless they're on that opt out of solicitation, they're getting hammered. I think one of my guys had 67 phone calls after he applied. Yeah.
Yeah.
I mean, he was like, he
Unbelievable.
was so frustrated. He was like, I literally had to put my phone away. So if your clients are coming to you, because this is a stressful time for them too, just make sure you're talking to your loan officer, say, hey, like the client's shopping or the client or the client thinks that they can get a better interest rate somewhere else, because then we can go back and educate on what's happening.
What happens now? Well, say they close their doors a week later, what happens to it?
I mean,
You know, I'm-
somebody would have to buy the servicing. It would have to get transferred somewhere.
Mhm.
But there was, I think it was Flagstar. I was just reading this online. They closed their retail operations and there was all these loans that were in the middle of processing and they got transferred to like the call center. And I mean, there was people just blowing up messages on Facebook about like what a, you know, bad time it was.
Yeah.
Shit show.
Yeah, right.
The shit show. So, yeah. So those are just really good tips to know about right now. And any questions on rates, like how we calculate them, other than, you know, the few examples that we've shown. Anybody on Zoom?
Yeah, please answer questions. We got plenty of time.
How do I make this bigger? Oh, wait, I gotta stop screen share.
Yep.
Stop share. I just wanted
There
to
we
check
go.
the chat.
So,
Yes.
I forget who suggested it, but someone along the way of some training suggested following Mortgage News Daily, which shows you the rates today.
Oh, the rates.
Yeah, so what's your thought? I mean.
So,
What are your thoughts?
We'll talk
Yeah.
about it.
So
We'll put it like that.
this has actually been helping me, not that particular thing, but every morning I've Googled what I tell my customers not to do.
Right.
And I Google national average interest rate 30-year. Because it's so all over the place. And I think if the customer just sees that, they don't feel so bad about them not getting the 3% interest rate that they still think that they should be getting. Like I still have conversations about this. So just getting the, you know, so I don't necessarily think it's for educational purposes only. So you know what like a national average is, but not something I would ever convey to your client. I would never say, like I tell my clients, the national average is this, but your rate is this based off of your profile. Like I always love it when the 600 credit scores are like, I'm gonna shop rates.
Yeah.
And I'm like you're like you should be happy that you've got a lender to prove you, even if it's at a 1.5 higher is better than renting, you know, unless you can't afford the payment, then back down your search. But yeah, I wouldn't not use it, just not, yeah, for your own knowledge of kind of to see if they're shifting up or down. That's what I would use that for. Like, so you're keeping yourself informed on what's happening with rates today. Yeah, nationally. But I do get customers all the time, and they call me, they're like, rates went down today. And I'm like, no, actually they went up. And they're like, am I getting that lower rate? They just dropped today. And I'm like, they didn't. Where did you get that information from? Well, I saw it on Facebook. So just, yeah. But no more classes or no more questions on Facebook from anybody? Anybody here?
Everybody's good?
Any more green beer? I know the people on, yeah,
Carly,
there's more, we can make more.
remember though, because you were talking about points and you know what the cost is. It's all based on a percentage. It's in the loan size. So obviously the points and for $100,000 loan is going to be a lot different than a $300,000 loan. Okay, that's what's said is whatever that particular borrower's profile is, whatever that points cost is going to be based off of that and their loan size. So which can be paid by, you know, seller credits, which is a great thing to have. If you get a deal that they have seller credits, you can use all of that or a portion of that towards the points cost to buy the rate down. Or we even educate on the tax proration being applied at closing to help with that, offset that extra cost,
Oh, yeah.
to really kind of have them just have more of these. I've had a lot of clients lately. I just educate on what the tax proration is. They have enough money to cover their own down payment closing costs already. I'm like, hey, but you're getting this extra $3,500 from
Yeah.
the seller proration. Let's use this to buy the rate down a point and get you even lower rate. And they're like,
That's a
"You
great
can do
point.
that?"
We do
Yes,
that
you
all the
can.
time at Cross Country because the banks also aren't typically well known for putting the prorations on there, which it's a conservative approach for sure, because they don't want the customer to rely on the tax prorations. But if you're buying a house, you're getting tax prorations.
Yeah.
So why would you, right, like, why would you not let the client know, hey, if you do want to buy this extra point down, you can use this extra credit you're going to be getting at closing to save yourself a quarter, half, or 1%. Yes, thank you.
Exactly.
Thank you so much.
That's what we
Yes,
do.
that's what we do.
We
I know.
educate.
We educate. I mean, Cliff and I say this all the time. We've literally built our business on not just being loan officers and saying, hey, look at my rates and, you know, what I'm going to do for you. We educate, and we actually want the customer to use their money. I mean, this is one of the biggest purchases they're gonna make, even if it's their second or third house. It's a huge purchase. They should understand where their money is going. And if they don't, that's a problem.
Right.
You know, I mean, we get questioned, like people all the time that say, I don't, what's your pre-approval? Are you approved conventional FHA? I don't know. Do you know how much money you have to put down? Nope. Like, that's why we push the extra opinions, because at the time I talk to a customer at a pre-approval, they know walking into a house what their cash to close is going to be. And I simplify it. I don't talk about points until we get a little bit deeper. I include points like in the initial conversation, and I give them a range. Your closing costs are going to be between 65 and 7,500, because there's that little variation of the points if they choose to buy it down. Or if they choose to buy it down like 3 points, well, then we're going to be out of that range, but they know why it's out of that range because they're choosing to spend the extra money. But they should know, I simplify it and I say there's three main charges you have when you're buying a house. You have your down payment. So whatever down payment we select, that's the best program for you. There's your estimated closing costs, and there's your homeowner's insurance. You're going to choose your homeowner's insurance through any company, and whatever amount you get, that's what you're going to pay. But this is an estimate. I always say between 800 to 1,000, because unless they get some crazy coverage. And if they do have it over, we actually have people that we can refer to try to help them get it down. Because I've seen some crazy insurance coverages before
What are you
too,
insuring again?
but that's the average.
Sounds like it's a lot more than the house.
I have a question for you afterwards about manufacturing.
Oh, yes. It doesn't matter to me.
But a good topic earlier, real quick too, guys, is that, as the reason a couple of you guys have mentioned is renovation loans. These are the kind of topics and things we want you to bring up, because we can make a whole class out of all this stuff.
Yeah.
We'll spend the time to go over every facet of that transaction, construction, renovation, whatever it takes that you guys want to go over.
Anything.
Just let us know.
We run out of ideas. We're like, what are we
I
gonna
know.
talk about next month? The renovation.
Yeah.
Yeah, we could totally do renovation loans. Yeah, because I think they're bigger now, or we're getting a lot more questions on it too.
Yeah.
We'll do that. We'll tell Amanda to add that
Yeah,
for the calendar
we'll
for
just add
next
it
month.
on.
We always tell her. Oh,
Yeah.
okay, so
We don't need
beer
vodka for
class.
Yeah.
Tito's next time.
Tito's and yeah.
Yeah, Tito's next time.
Yeah. Yeah.
I think we might start getting in trouble from Chuck.
I
He's
know.
like, every class you're bringing alcohol.
It was non-alcoholic. It was Grupo Duels.
So on the I think I had an email from a different lender about manufactured homes, and I think one of the criteria was that it has to come from the land.
Yes.
So is yours the same?
Hmm.
So then that one that we're looking at, I don't think the land comes with it.
It's not attached to the land.
Yeah.
It's got to be affixed to the land.
Foundation.
Permanent foundation.
Not that, like they lease the land,
Nope.
like they're not gonna purchase the land with the.
Mm-mm.
manufactured home.
There may be a small credit union that may do something like that,
Yeah,
but as far as like the banks merge, they're not even gonna look at it.
You'd have to have a
We just
portfolio loan for that.
Portfolio for sure.
Sorry.
Cash.
Oh, Zuri's is like, I got somebody.
He works out of his truck. Just sign here. Oh,
Oh, sorry, okay.
Yes, but yeah, I mean, if there's a bank that will do it, that's a non-qualified mortgage is what that's
Yeah.
called. So you have to find a bank that's, willing to do them. But there are some, especially in the areas where there's a lot of manufactured homes, there might be, but I don't know what rates and everything would look. No, yeah,
one of the few that we could, everything else we pretty much got.
Yeah.
So.
Thank you.
you're welcome.
guys.
Hi guys on Zoom. Thank you for coming.
All right,
Thank you.
later. Wait before you hit the end.
Oh, you want to do a screenshot?
No, do we have to hit the recording? Do we need to stop recording?
Oh, yeah.
Because it recorded. There you go.